I'm John Moran. I am the CEO and founder of Keller Williams Realty's At the Beach team and Smart Beach Investor. Kaylee Fusey, new agent.
Yes, sir.
Extraordinaire. Unbelievable how well you're doing. Jackson Stanford's stepping up and doing his thing as well. Yep. Remember to speak in the microphone, guys, so all our viewers can hear us.
Awesome.
Both of them. So yeah, let me just say this. First of all, this podcast is for owners, people that own real estate on Florida's Emerald Coast. That's from Navarre Beach, Pensacola Beach even, Fort Walton Beach, Okaloosa Island, Destin, Sandestin, 38 East and West, Inlet Beach, Panama City Beach, all that stuff, right? All these, I love it here. I absolutely love it here. So we're going to talk to owners about how great it is here and what's going on with a bent towards real estate.
Okay.
And then rentals, right? And people who want to own here. And people want to come and share our beaches and rent and everything, because owning here, I mean, let me just tell you this. My big thing, and I'm so fired up about y'all, and because you're getting started so young. I didn't start until I was much older, but wealth. Not income, not the money you make from your job. And I'll give you an example. Doctors can make a lot of money, $600,000, $700,000, $800,000 a year, but that's in wages. That's income, and they get taxed on that income, right? Uncle Sam wants a piece of that, and they tax. And the higher you earn from an income, the more you pay in taxes. But wealth is different. Wealth is how you get wealthy. Ooh, who knew? Right? But it's taxed differently.
It is.
If it's taxed at all. And I'll give you an example I like to use. Donald Trump, when he was debating Hillary Clinton, whatever years ago that was, and she was harping on he didn't pay as much in taxes as his assistant. And he leaned into the microphone. He says, because I'm smart.
Yep.
And it was true, because she was a salaried W-2 employee.
Right.
He had assets.
Yep.
All right. And those assets were worth something. And we're going to talk about that in the future. But wealth is created. We're going to use our income. People out there, use your income to invest in assets that generate cash flow, such that the cash flow you got coming in is greater than the cost for you to live. And as long as you have more coming in than it costs to live, you're set.
Yep.
You can work because you want to, not because you have to, and it changes everything.
It does.
Yep.
And that's what this is about. Living an unbelievably great life in Florida, at the beach, with someone else paying for it.
Yep.
Exactly.
How great, right? So before we get, let me learn a little bit about you. Jackson, you grew up here. Are you a local?
Yeah. So I'm pretty much born and raised here my entire life. Just finished up school at the University of Florida. Go Gators. And, it's funny. I've lived here my whole life. A lot of buddies going to Dallas, Atlanta, all around the country. And it's like, well, I want to go where everyone else is working their entire life to get to. So, I mean, I'm lucky enough to grow up in a place like this. I mean, it's extremely awesome.
You know what's really even cooler? Is you're going to sell them all investment properties. They're going to come out and hang with you and have fun, then go home and go to work.
Yep.
Yeah.
How great is
You get
that?
to stay here.
How great is that? Kaylee, what's your story?
My family and I moved here in 2013. I haven't looked back since. I went to LSU last year, my freshman year. And
Go Tigers!
Go Tigers! Yeah. I came home this summer and I decided that I didn't want to pay the out-of-state tuition, and I didn't want to come out of college 4 years later with a degree I'm not going to use, working a 9-to-5 in debt for the rest of my life. So I am here investing in myself and hopefully everyone else.
And y'all are here because I grew up in North Dakota, the geographical center of North America, right? Which means there's not a beach anywhere, right? And we came here and it's been terrific for us. Our family has prospered, it has done very well. We sell real estate, we own real estate, we live in real estate, we have a real estate property management business, all that stuff. And we're going to use this platform to help others, owners, buyers, sellers, renters, max out their experience here. So let's go ahead and get started. It's Thursdays at 5.
Yep.
Yes,
Come back here every Thursday at 5. Please give us a comment if you have anything you want to tell us or ask us. We'd love to hear from you. especially if you're from out of state or out of the area. That's really cool. Okay, so what we're going to do is we're going to get into it, the news, the vitals, the stuff that matters if you're an owner, renter, or a buyer or seller of real estate here on Florida's Emerald Coast. So Jackson, let's kick it off with you. A huge thing, mortgage rates.
Yeah, so obviously you're looking at the market in any industry. If you're investing, if you're buying, selling, you want to take a look at the mortgage rates. And so the average for an interest rate for a 30-year fixed mortgage right now today is 7.28%. That's down 1 basis point from a week ago. The current average fixed rate on a 15-year is 6.82%. That's up 11 basis points over the last week. Now, market experts and analysts are predicting that rates will move down towards 6 towards the end of the year. So something to watch. Another thing that goes hand in hand with that is inflation. And the Fed has opted to hold interest rates steady for the 4th meeting in a row. Those are going to be held around 5.25% to 5.5%.
So the anticipation is by the end of the year, 6-ish, somewhere around there,
Trending down.
Okay. Let me give you some perspective on what's going on. 2 years ago, it was barely over 2. Matter of fact, I think the mortgage on our house is 3 point something, low threes. Now, if I was to get a mortgage, it'd be 6 or 7, as you mentioned. That's a lot more on a month-to-month basis. It's amazing how the affordability goes away. And we're seeing it in the number of sales transactions.
100%.
Prices have not fallen. The number of transactions are. Now, there's some talk, though, if rates go down, that's affordability goes up. People can afford to buy our properties, right? For about 15 minutes, because then the seller's going to jack up the price, right?
100%.
So yeah, that'll be interesting we'll continue to watch that for you. But here, before we move on though, let me give you some other perspective. In 1980, all right, and this is the old guy on the hill, when I was your age, right? In 1980 though, the mortgage rates were 18%. Can you imagine? 18%. And they were talking about how you get a deal, you get those things down around 14 or 15%. We're freaking out because they're 6%. Now, keep in mind also, the house in 1980 in the U.S. cost somewhere around $46,000. Now it's like 350 or something nationwide. It's higher than that here. So, but mortgage rates are a thing. Affordability is an absolute thing. The other massive impact that we have to watch, because it's all about supply and demand. If we have strong demand, people will pay our prices. They'll pay our rents. They'll pay for our real estate. They'll invest and have great careers building wealth. Unemployment. Kayla, you looked into that. What do we got on unemployment?
I did. So I'll give y'all the numbers and then I'll tell y'all why the unemployment is important. So in 2020, the unemployment rate went through the roof, COVID, which we all know. In 2024, today.
Hold on, dad moment. Please speak into the microphone.
Okay. Today in 2024, the unemployment rates are down tremendously compared to COVID times. They were sitting at 14.8%, and right now they're at 3.7%. So since those rates are down, that means more people are working, more money going into people's pockets, and more people going on vacation because they have extra money to spend.
Okay, that's something we're going to have to watch, because the government plays a lot of games with these stats, right? They'll say unemployment is down because more people are working. What they're not telling you is they're working 2 and 3 jobs. All right. There's still a lot of people that aren't working. And I look around. You guys tell me, Jackson, it was hard to get a job out of college.
100%. Another thing with these jobs that these people work, they're not salary jobs. They're not benefit related jobs. These are, I'm working 3 hourly jobs, 12 hours a day trying to make it by. No one's working 3 great cushy salary jobs that are going to give them great opportunities to advance in their careers.
Yeah. So unemployment's going to be a thing we're going to have to watch, because if prices continue to go up, we mentioned inflation earlier, that's a thing, because if you don't have very much money, it's going to be hard to spend. COVID was a big plus for us. The government gave out a lot of money, PPP loans, stimulus checks. They put a moratorium on rent, so a lot of people didn't pay their rent. They stopped making student loan payments. There's a lot going on, so people had a lot of time and money, and they came down and spent. So I think anybody here who owns property saw their rental incomes go to the moon. So that is cool. That is cool. All right, so there we are. That talks a lot about the supply and demand in terms of the vitals that we watch on the daily, just from a standard financing economics thing. Another thing we want to watch is supply and demand from number of properties for sale. Is there more or fewer properties coming on the market? Are prices going up or are they going down? Days on market, up or down? All these things that relate to real estate. So we're going to talk about those. I got those right here. I'm going to race through them. Katie, you're going to put them up on the screen. Is that true? Okay, so let's talk about Destin first. And when I say Destin, I mean Miramar Beach, Destin, Fort Walton Beach, Okaloosa Island primarily. Okay, let's talk about condos. And what this graph is condos over 20 years. So going back to 2004. And if you look at this, in 2004, prices were starting to go up and they peaked in 2005. This was the stated income, no doc loans. You guys were even alive? I mean, right? You guys were barely going. But what happened back then is George Bush, of all things, came out and said, everybody deserves a house. And they created something where stated income, which means you went in and said, hey, I make X of dollars of money, no taxes. You didn't have to show any tax forms, no tax returns, none of that. You just filled out a form that says, I make this much money and I'm going to pay this much back. And everybody was getting loans. The movie in the book, The Big Short, Jackson, your dad's a banker. This hit home with him. He and I went to that movie. I remember when it was out. But yeah, you see prices on condos in 2004 were at just under 400,000. In 2005, they're at 520. That's a big jump. And so money was cheap. It was easy. Here's the thing, guys. Money's easy. When you look at this, back in 2004, 2005, money was easy to get. Anybody could get bucks. All right. And that drove prices to the moon. And then what happened is the banks started to fail. The subprime mortgages started to fall out. Lehman Brothers goes out of business. Salomon Brothers goes out of business. A number of banks collapse. And the Fed says, whoa, stop lending, stop. And it just shut down. Short sales foreclosures take over, 2006 to all the way down to 2011. So prices go on condos here, 520 all the way down to 210. That's a drop.
Yeah, that's the cliff.
That's more than half fall, right? But then in 2012, we started to get our feet under us, and it was a grind. If you look from 2012 to 2020, it went from 220 to 355. Nice returns. These are nice returns by all accounts. Normal.
Would you call those healthy? Yeah,
I would call them perfectly good returns. Okay. But then if you look in 2020, March of 2020 is when COVID hits. Okay. And the government jumps into action. First thing they did is shut all the businesses down, right? You can't go to work, quarantine, stay in home, all that, right? Businesses had to close. Unemployment spikes. But when unemployment spikes, that means you got to give the people money. So the government stimulus checks, businesses, PPP loans, all this money. So now you have people going nowhere. So they're not spending any money. They're getting money from the government and they're paying down their debt. During the 2020-21, U.S. personal debt went to the lowest point ever. People were paying off their credit cards. They weren't buying anything. Maybe on Amazon. My daughter's an influencer. She makes a lot of money selling Amazon stuff. And that's when she blew up, right? So yeah, they did some spending, but they weren't going out for dinner.
Nope.
They weren't doing much, right? They paid down their debts. And then what happened is they started letting people out. They started to travel. Destin in Florida opened up on, what is it, Memorial Day? Is that the first holiday of summer?
I think so.
All right. Yeah. So Memorial Day, they opened and people came to the beach. It was not so. And now they have money and they have time and they started spending. So look what happened in 2020. It went from 355 to 21 to 420,000 to 22. In 2 years, it went from 355 to 527 and then to 560. That's good times.
Yeah.
That's good times. So if you guys look at this graph, the way it works is this: buy and hold. If you would have sold in 09, 10, you're going to get hurt. But if you would have held, you'd be sitting really good right now. Really, really good. Let's take a look at the rest. Destin area houses. This is even more pronounced. Kind of the same curve though, but yeah. And this is Destin, Miramar Beach, Sandestin housing. Look at how much the houses are now. 1,050,000. Easy for me to say. 1,050,000 last year. Now it's fallen back a little bit to 981. But that is significantly higher than 320,000. So if you guys could have bought a house back then, oh my. And where's it going to be in 20 years from now? It's going to be more.
Yep.
All right, this 30A, crazy. The reward is massive for 30A if you bought and hold. Okay. 30A houses. Yeah, same thing.
Same trend.
Yeah. Look at this. From 2020, the median sales price on 30A for a house, 2020, 3 years ago.
Let me ask you this. We're talking about buying and holding, and I know that sounds pretty easy and fundamental to say, but I mean, the trend is there. That's granted with a financial collapse and a pandemic, and look at what they still did. If you held over that time period, you're still safe through all of that.
Yeah, for sure. And let's do this. Anybody get good at math? Here, let's just say you bought in 2007. Okay. 17, 20 gives me 13, 14, 15 years? Let's just say 15 years. And times 12, I'm doing quick public school math here, bear with me. That goes there, 2, 3, okay, good. 5, 1. Okay, so that's 180 months. Okay, and let's say you made, I don't know, $1,000 a month. It's $180,000 you pocketed in rental income. Not bad.
It's real money.
That's real money. Yep. And look at this. You go from 950,000 in 2020 to 1.6 million 3 years later. You're a winner if you're buying in 2020. Amazing. Panama City, same thing. Same thing. And again, you look at these graphs, buy and hold because you win over time. I can't stress this enough. If you're online, drop us a comment. Drop us a comment. Tell me what your story is because I'd love to hear it. I can tell you this. We bought a couple properties. We bought one property for $200,000 back in the day. I wouldn't sell that thing for under $570 right now.
Wow.
And it pulls in $80,000 a year in rental income. Yeah. Buy and hold, people.
Don't let it go.
Don't let it go. So, and we're going to talk about this in the wealth stuff as we go forward over time. But if you can find a way, I saw a report on YouTube. You know what YouTube is, right?
Yeah.
You kids know what YouTube is, right? But at any rate, I watched this. It was a news report from 1980, right? I'm so-and-so reporting live from wherever. Houses are so expensive, nobody's ever going to be able to afford a house ever again. I'm talking about Joe and Mary Blow here looking at a house. How much is the house? Oh, I know, it's $67,000. I don't know if we're ever going to be able to afford this house. $67,000. And nobody's ever going to be able to afford a house ever again. Right? I wish I could have bought like maybe 1,000 of those 67,000 houses.
That's a great. Kaylee and I, we did an open house yesterday, and we had an older couple come in, and they were telling us the same story. They were like, "How much were we asking?" Told them the price. They go, "Man, that's steep." But let me tell you, we've come down here every year for the past 20 years. We were down here 10 years ago. We walked into a place just like they walked into our place yesterday, and they looked at each other and goes, "Man, that's just too much money. I can never imagine spending that much money." And they looked at us and they said, "I wish I would have pulled the trigger back then," because it was the same thing over and over again. Over and over.
Kaylee, ask me say this. What is the investor's dilemma?
What is the investor's dilemma?
Oh, great question. So here's the thing. Back in the 70s, an investor in Phoenix, Arizona, you've heard of that, right? Back in the 70s, he's in Phoenix and the houses were getting so expensive. He was just pulling his hair out. I'm like, oh my gosh, I own all these houses. And there's no way prices are ever going to keep going up like this. I got to sell because they'll never go up. I got to sell. But can you imagine if you would have held on to them from the 70s in Phoenix? Phoenix is blowing up. It's just, so this is the investor's dilemma. You look at these prices, $560 for a condo in Destin. I bought mine for $220.
Yeah.
I bet you wish you bought a dozen of them. And you know what people are going to be saying in 2043? Oh my word, condos are $1 million too. I bought mine for $560. Right? Guys, if you can figure this game out, Get into it. Beg, borrow, and steal. That's what they asked that realtor back in the 80s. What would you recommend to buyers? I would recommend you buy, beg, and steal. Do whatever you can to get in a house. And that couldn't give better advice now.
Buy now and hold.
Buy and hold. Good answer. Nice. Okay, what's next? We covered supply demand. Oh, our main story. Did y'all hear about this Calypso 3 thing?
Panama City?
Panama City, Calypso 3. Didn't crash. That was
just the alarms.
Yeah, just right. No collapse. But they did have to evacuate.
Yeah.
Right. If anybody's watching, you own a Calypso Tower 3, let me know, because this is a thing. I remember it was 2 weeks ago from tomorrow. It was a Friday, and Courtney sends me a text, and then beep, beep, beep. I start getting all these texts. What's going on with Calypso? What's going on with Calypso? And we looked into it. What'd you find out, Jackson?
Yeah, so eventually what we found out, they did have to evacuate the building, but it was a structural failing, but it was the railing. One of the upper railings is what we gathered. And so what happened was they had to sound the alarms and eventually get everyone else out of there. It turned out to not be the structure was going to collapse or anything like that, but it is a big deal moving forward. And a lot of it had to come with some of the inspections that were coming up.
You know what we forgot?
What?
The capital gain thing in Vermont.
I have a great story to tell you guys about taxes. Y'all want to hear it?
Yeah, let's go back to that. We'll circle back, right? This is the first one.
You're going to hear about it anyway.
Because this matters. Because this is, if you have money, and we all want to have some money, this matters. Let's talk about what's going on and what is going on in Vermont.
So Vermont, everyone listening here says, I thought we were talking about the beach. I thought we were talking about Florida. It's important. I'll tell you why. Vermont is one of 10 states flirting with the idea of taxing unrealized gains. That's important.
Stop taxing unreal. We're talking about capital gains.
Yes.
Right. So what Vermont wants to do, and this isn't just Vermont. There's 10 states.
Yep. Mulling it over, seeing if they can get away with it.
Because they're looking for money. Think about this. Everybody's struggling with capital gains. We got 1031 exchanges. We got all this stuff, tax deductions, everything. Now they're going for your unrealized gains. Okay, keep going, Jackson.
So what that means, basically, it's the percentage that they're proposing. If a business makes $3 million on paper, that business could owe $131,000, even if they don't take out a single dollar of that in cash. Basically, like capital gains, this new tax would cut into investment returns and leave well-off investors less of a reason to deploy their assets into wealth-producing investments.
Okay, here's an even crazier thing. Let's say your wealth is in a house, okay? And let's say your house is now worth $4 million, $5 million. They're going to tax you. I think Vermont's talking about 8.75 here, it says, on the unrealized gains. Okay, that means you're gonna get a bill.
Yep.
But you didn't sell anything to get any income.
Anything.
So what are you gonna pay that bill with? The income that what if you don't have the money? And I'll tell you how this works. Okay, I lived in Chicago for a long time before coming here. Okay, it's called gentrification. So what happens in big cities is this. It gets really expensive to live in the cool places. So the artists and the cool people, the musicians, the cool people move to crappy neighborhoods because it's cheap. But when they move there, they make it cool because the cool people are hanging out in this crappy place. And then the people with money, like, wait a minute, I want to be by the cool people. And then they start moving in and they start paying more money. And the rents go up and the values go up, right? And all the people that lived there before, right? Maybe an immigrant that had lived there for 80 years is retired and they have no income, but they have no mortgage. They're just paying some taxes. But now because the prices have gone up, the property taxes go up and they can't afford the property taxes. And now these older people, even though they don't have a mortgage, are forced to move, right? They got to leave the house they grew up in, owned in their family for 100 years, but they can't afford the taxes because the hip people showed up and then the money people showed up and now the tax people are showing up.
Where are they going to go?
Where are they going to go? They're going to have to go to some crappy neighborhood.
Yep.
Now, yes, you can sell your place because it went up in value. You're going to make a ton of money. But you know what? Now you're going to go buy something that's now a lot of money.
Now you got to redo the whole
cycle.
cycle.
Redo the whole thing. Gross. And now they're trying to do that with people who have a lot of wealth. But again, like if they come to me and my condo went from 100 to 500, I see a $400,000 gain. But I don't see that unless I sell it.
Exactly.
And if I don't sell it, I'm going to get penalized.
Now, let me ask you this. Say you own that $3 million house, it goes up 3.5 and you pay taxes on that increase. What if it goes down?
What if it goes down?
You don't get a check from Uncle Sam saying, well, now since if you're going to pay you, I'll pay you. That's not how it works.
I don't know, man. I don't know. But here's what happens. If this happens in Vermont or wherever, here's what happens. Say goodbye, right? So here's what this Kornheiser gal is one of the people pushing this. If this doesn't go through, they say they have a fallback plan to tax high earners if the wealth tax bill doesn't win enough support. So instead of targeting assets, the second bill adds 3% surcharge on incomes above $500,000, bringing the state's top income tax to 11.75%. Okay. Florida has zero income tax. That's why people are moving here, right?
Yep.
All right. So say goodbye to your doctor. Your doctor makes $600,000. They just got a tax increase. Say goodbye to your lawyer, your high wage earners. You know where they're going to go? Florida.
Yeah.
They're going to leave New York. They're going to leave California. They're going to leave and come to Texas, Florida, South Dakota, places where they don't have state income taxes. And we benefit. Come on over, folks.
Yeah.
Come on over. We'll find you up a spot. Okay, so that's what's going on with the taxes. So here's the thing. You want to earn a lot of money so you can invest it in wealth building stuff. And then getting the money is one thing. Keeping it is another. And the tax man is coming for your money. And that's cool. We want to pay taxes. We want good roads. We want a strong defense. We want all that. I won't get into politics here, but there's a lot of politics that come into where the money goes.
Yeah, 100%.
Okay, so back to Calypso. There's a good thing, right? So here's what's going on with Calypso, guys. Do you want to add on? Do you have anything you want to throw in?
Correct me if I'm wrong, but Calypso was one of the newest condo buildings in Panama
Okay,
City, right?
perfect. Yes. So here's the way it works. It's 3 years old.
Mm-hmm.
Okay. So a developer builds Calypso or a development, and then they turn it over once it's done to an HOA or condo association, homeowner condo association. But before the COA, the condo association takes it over, they do one last run through the building to make sure what they're getting is good before they take on responsibility. And in this case, that's exactly what they did. And they had an inspector go in there and they found that the railings on the 21st floor and down were not substantially good enough. All right, here, let's see what they say. Blah, blah, blah. Condo association has an opportunity to hire engineering firms to perform inspections. Okay, this guy did that and he realized possibly there could be a problem and did several destructive analyses and discovered there's problems. Called in the city officials said it's bad enough where we have to evacuate.
Everyone get out.
Oh, yeah, crazy, right? So now the lawyers are lining up. They're doing their thing, right? It's going to get ugly. But here's the bigger part of this, you guys, is what's called a SEERS thing. It's Structural Integrity Reserve Study is what SEERS is. And what happened is do you remember a couple years ago over in Sunnyside, that condo fell down?
South Florida.
Yeah, in South Florida, 98 people died.
Mm-hmm.
Tragedy, horrible, right? So this condo falls down. And there were structural issues. Everybody knew there were structural issues. They knew things had to happen, but for any number of reasons, they weren't addressed.
Mm-hmm.
Okay. Bad news happens. It crashes. Government steps in. I don't know if it's an overreaction. Probably not. What happens, guys, is you own these properties. It costs a lot to maintain them.
Mm-hmm.
Okay. So what happens is you get deferred maintenance. You kind of push it off. We're not having any problems. Let's go ahead and push this off for a while. Mm-hmm. Okay. And time goes by, rust, decay, whatever, storms, and you don't really address issues, and small things become big things. And pretty soon they become big enough, they crumble. Okay. You can't have that. So now what happened is they passed a law that said you have to do these SEERS tests, these structural integrity reserve studies, two-part deal. One, they send a person in, an inspector, to look and see what's going on, if there's anything that's going to cause problems, which is what part of that. And if there is, you got to shut it down. The second part of it, and that's called the milestone survey. Matter of fact, we have Katie, we have a video coming out Sunday of the milestone. We're going to drop it on Sunday if you want to check back, where John Skinner, who operates in Panama City, he knows this stuff pretty well. We talked about the milestone inspection.
Milestone is every 25 to 30 years, right?
Yes.
Okay.
Yep. Exactly right. So, but it has to be done now too. And then every 25, 30 years, whatever it is. So that the milestone is that initial inspection.
Yeah.
And then the second phase of this is a more comprehensive inspection where they look at the reserves of the building and make sure that the HOA has enough reserves such that if the elevators are about to crash, you can afford to go ahead and fix them. So yeah, and if you want to look at it, we'll post in the show notes where to find some of this information. But I'll just tell you right here. Do we have anything on this, Katie? Okay, we'll post in the show notes. Must be done by December 31st of this year. We're seeing it in the condos all over, up and down the coast right now. Must be a licensed engineer. Must be commissioned for all buildings 30 years of age or older with 3 stories or more.
Okay.
That's a lot. Not everyone. If you don't have 3 stories, good for you. Good for you. Any 3-story or higher buildings within 3 miles of a coastline. That's almost everything for us.
Yeah.
Right?
That's the market.
Have a Sears completed for any buildings 25 years or older. All buildings subject to Sears should have registered with DB, which is Department of Business and Public Relations. Is that what it is? Professional Relations. I guess I got that one wrong on the test. I don't know if it matters. Failure to obtain a Sears is a breach of the officer's fiduciary responsibility to the owners. That'd be a problem. Okay. Associations will be no longer permitted to waive, reduce, or use reserves for any other purpose than for those required in the Sears, even if a majority of the owners want to and vote to do so. This is big stuff, people. This is big stuff. Check the show notes. We'll show you what's in it. But you're feeling it because your HOAs are going up.
Yep, we're seeing that.
For sure, right? You're seeing it in these special assessments that are coming by, and it sucks.
Yeah.
These things suck, but they got to get done. And once this wave wash is over, you can have a great building, and it's gonna be great.
Yeah.
Sailing from there.
The thought process is you get it done, don't worry about it in the future because everything will be run right. Now, like John's saying, the short run, it's not the most ideal thing, but once it's good, it's good.
Yeah, it sucks, but we got to do it. I mean, it's expensive. I'm holding my breath. It's per door. I know some of these buildings have $100,000 per door. So if you own 2 or 3 properties, yikes. All right. So yeah, check that out. We'll have it in the show notes. Finance, Dave Ramsey. What do we know about this, guys? What do we know about this? Did you read that article in the Wall Street Journal?
I didn't have access to all of it.
Did you read it, Johnson?
I checked it out. I'm sure most of you guys watch and know Dave. If you don't, you can do a quick search. She's re-blowing back up on TikTok now. Even as a 23-year-old, I see him all over my TikTok. Dave's got a simple philosophy. It's, pay off everything you can, work as hard as you can, put money away for your future. That's great. That's the American dream. The more and more we get through this late stage capitalism, the less and less that's gonna pay major dividends down the road.
Tell me more. Say more. This is interesting. He's got a point. Let's hear what's your position.
My thought process is: back in the day, you get your college degree, you go get your nice job, you're fine. You'll have the 2-bedroom house. You have the
Hold on a second. When I went to college, you know what the first semester cost me?
How much?
$550. But I was on scholarship.
There you go.
You don't want to hear how much my 1 year of school costed.
Yeah, right?
So
it was more than that, wasn't it?
Yeah. Long story short, my point is here, you got to think smart. You got to think outside the box. Dave's got the right thing. If you're going to stick to what he's saying and put everything away, pay off your stuff on time in the right manner and be responsible, you can go very far. Now, today, there are better avenues to do that. What we talk about on this show, investing while you're young, holding, being able to maintain that, do everything you can to hold your assets for as long as possible. That's really, I think, going to pay more dividends in the long run as we see kind of how this economy progresses into the later stages of this free market capitalism that was an experiment. You kind of have to think outside the box at this point. You're not going to be able to read a textbook the past 50 years and know how to navigate the next 100 years of finance.
It's really amazing. I'm not sure. Is college required?
No.
Kaylee, you went to college. Jackson, you graduated. Kaylee,
Yep.
What's your story?
I went to college for 1 year, had a blast. If I could stay there, I would have so much fun. But I know that it wasn't sustainable for me, and it wouldn't have set me up for the life that I want to live.
Yeah, I agree.
Especially out of state. If I would have stayed in state, it will still be very expensive, but the out of state is crazy.
And just because you go to college, there's no guarantee that.
Exactly.
No, not at all.
Yeah, the return, I'm not sure the return is there. And we can talk about it. But I want to spend this time talking a little bit because y'all are 20-somethings. We're going to have Anna, my daughter. She's going to come and join us too because she's a 20-something, barely, right? All y'all are barely 20-somethings, which is good because you're the future. And I worry about people my age that aren't going to have enough money to retire. They're going to be Walmart greeters, and God bless you if you're a Walmart greeter, love you, whatever. But I don't think that's a life most people working a checkout line at 75 years old, probably not the thing, right? But pensions are gone for the most part. I mean, the government's still there a little bit, and some companies have pensions, military, whatever. But that isn't there. You have 401ks. That's a newer thing, right? That came out in the 80s. Roth IRAs, that type of thing. But I mean, 80s, you guys weren't even a thing, right? I was in just getting going. So that's not a time-tested thing.
No.
And then Social Security, that isn't even that old. If you think about it, Social Security started, I think the first person who got Social Security was in 1930, and they got like $45 for the year or something like that. Don't call me on that, but it's something like that. So I'm not telling you Social Security is going to get you out of rice and beans.
No.
Okay. But what Dave Ramsey is saying, and he's right and he's wrong, right? Because so many things these days are right and wrong. Do you know who Dave Ramsey is?
Not really.
Probably not, right? So he's 63 years old. So you're probably not following 63-year-old radio guys talking about debt. But he made a career, and a quite lucrative career, helping people get out of debt. Stop spending, shrink your vehicles, ride a bike, walk. Don't go out for steak dinners, eat rice and beans, save, pay down. Not wrong?
No. Not at all.
But that really puts a crimp in some fun.
Yeah.
It does. I was actually talking to one of my friends last week, and he is very big on saving. He's about to get married, and his family was shocked that they were going to go on a cruise for their honeymoon because of how tight he is on money, which is not a bad thing. I think it's great. Saving money. A lot of people can't do it these days, but I think it's just your personal opinion on how you should handle your money. And he is one of those guys who is very tight with his money. So,
but you gotta be careful, because think about this. We talked about inflation earlier. If you're saving your money in a bank and getting 1% or something, and yeah, I know, because I'm doing it myself. You can get CDs at 5%. You can buy bonds, T-bills, whatever. But most people don't have that much money. They start savings account, and it sits in a savings account at a bank, a deposit, right? You're getting like 1% on that money. But inflation's at what did we just say? It's 3.5%, 4%. Matter of fact, putting your money in there, you're losing 3%. Savings ain't much savings.
Yeah,
you have to invest in something that moves with inflation, if not above it.
I once again, I don't think there's anything wrong with Dave Ramsey, but if you look at any article in the last 10 years, what do you see? The 1% gets bigger, the middle class gets smaller, and the lower class gets bigger. If you listen and do what 90% of people are doing, you're going to follow those trends as well. If you just rely on a 401k and all this stuff, you have to think a little bit outside the box. If you follow the trend, you're going to be a part of that trend.
Absolutely. So let's table that conversation now, because we'll have that conversation for 20-year-olds, 20-somethings, 30-somethings. I wish somebody would have tapped me when I was 20 and said, dude, start it now, right? I would have bought one of those houses when they were $215,000, and I would have it right now. You know, I probably wouldn't be sitting here. I'd be sitting on a beach. Wait a minute, I am. But yeah, right. So that's what we want to do. So we're going to talk about that with Anna, and we'll drop that as a video in a week or so, Kenny? Something like that? Okay, cool. So there you go. We got some finance. This is the way it's going to work, people. We're going to talk about what's going on. We'll probably hit some restaurants or some fun stuff, tell you what's going on here. I think a bridge in 30A is kind of a nightmare.
Something like that is what we keep hearing.
Oh my gosh. It took me 5 years to get from one place to another. There's no doubt. There's something new in Panama. There's new stuff everywhere, right? And I just saw that Allegiant just opened up flights to and from a lot of places.
Yeah.
So that's cool. That's cool. So we're going to talk about things like that. We're going to talk real estate because that's what this whole thing's about. We're going to talk about how cool it is here on the beach. What do we got going next week?
Next week we have an open house on Wednesday. It's actually going to be 2 separate units. Venus.
Okay.
Over in 30A. So
no, Venus is on Oculus Island.
Yep.
Oculus Island.
Yeah.
2 to 4 next Wednesday. Me and Kaylee will be out there. Please come by, drop by. We'll have information up, posted on our socials the next few days leading up to that.
If they're not in town, can they still see it?
Yeah. So we did it last week. We did it yesterday. We're going to do it again next week. Every open house at 2, we're going to post a link to our live stream. We're going to live stream it first, get that information out to all you guys who can't be here, because as we know, everyone wants to be here. Not everyone can be here all the time.
Where do they see it? They can see it on Facebook, Smart Beach Investor, YouTube,
Yep,
Smart Beach Investor, TikTok. Is it on TikTok? Do we have Smart Beach Investor TikTok? Okay, Smart Beach Investor TikTok, Instagram, Beach Investor. Anywhere you get your social media, you can find it there, right? So yeah, check it out. We're always posting. We're doing open houses. We're going to be getting into our best deals. We're going to start analyzing deals. So cash flow. We're all about finding properties where you can cash flow. That's awesome.
Yep.
Or at the very least, you can find somebody to subsidize. Maybe, I mean, if I asked you, guys, if you bought a place and you could get it for half price, would you at least look at that?
Yes.
Yes, of course.
Think about it.
Why would you not?
Why would you not? If you can get a place that you're going to use and it's only going to cost you half price or maybe a quarter, because you're catching renters, and then at some point you catch up and you can get rid of it, or you can go 100% renters that'll cover it. You can refi any number of things. Guys, we got to make money, so the cash throw off is enough to pay for student loans, to pay for your house, your lifestyle, all that stuff, and then that's when life really.
And you own a major asset.
Yeah, that'll appreciate in value, and somebody else will pay down. The renters. How great. Okay, so that's what we're doing here. Give us a like, a follow, all that stuff. Tell your family, your friends, your cousins, and even some strangers where we're at, all right? We'll see you next Thursday. You guys good?
Yep. Thank you guys.
Thanks.